Let's get started. Part 3, the LIFO, the last in first out, based on the matching principle with the revenue. That means that we consider current cost matched with current selling price. Question 1, what are the ending inventory and cost of goods sold under periodic LIFO at the end of April? Again, the example, we will figure it out. The cost of goods sold and ending inventory under periodic LIFO and perpetual LIFO. Periodic means we calculate cost of goods sold at the end of the period. And the perpetual means we calculate cost of goods sold every time we sell our product on sales, like this case, that's on the sales on April 23 and April 29. So based on the matching principle or with the revenue. Okay. So first, what are the ending inventory of cost of goods sold under the periodic LIFO? So LIFO means we assume that our very similar inventory purchased the different time. We consider the first inventory out is the last in. Last purchased inventory is the first sold out. Okay? So total cost of goods sold on the periodic, so we just sum up these two sales amount, 650. Got it? Then, how do you get this cost of goods sold in total amount? Last in, first out. So here you go. 300 out of 650 times 14. So what is the remaining? Right. 350. So 350, right? 350 times, there you go. So that is the order that we assume that we sold our inventory from the last in. The 300 units with the unit cost of 14, and then 350 out of 400 with the unit cost of 11.75. Got it? So 8,313. That is the total cost of goods sold during April based on the LIFO periodic inventory cost flow assumption. Okay. That is for internal users information. So 12.79 is unit cost. And then ending inventory, how do you get it? It's now very easy. Again, 950 was total inventory purchased during the April minus 650. And then, how do you get the ending inventory? Right, the simplest one is 11,400 is the inventory purchased in dollar term in total minus 8,313. But we also can calculate. Do you remember here we sold 300 and we sold 300 out of 40 here. So we sold 200. We sold 650 from 300 here and 350 out of 400. So the remaining is 50 when they purchased this, the inventory April 15th. The inventory cost 11.75 plus now that is the remaining as well. So times $10 inventory cost. So that is the way to get the ending inventory. It's much easier to understand, right? But anyway, if you want to get the amount, very simple way, we can get the same result. Then let's make sure that if this total amount is the same as the inventory purchased in number of unit and in dollar term. So 11,400 and 950. We got it. Okay. Now let's move on to perpetual LIFO. Perpetual LIFO, again, we recognize the cost of goods sold not the end of the period, but every time we sell our product here and there. right? So cost of goods sold under the LIFO, now you can get hang of it. Here, how do you get it? Okay, this is now 450. Then it's very easy. 400 from the last in at the time we sell times 11.75 plus, now what number do we need? That's correct, the 50 because we sold 450. We already counted this 400 inventory purchased on April 15. So now we need additional 50 inventory purchased, beginning inventory. Okay, so 50 times $10. So 5,200 is cost of goods sold at the time we sold the inventory 450. Okay, then what about the cost of goods sold? Here we go. Now the last in, first out. Do we need this number here? No. Now we're gonna use this 200 from there because we are following LIFO, last in first out. Even though we have the remaining here beginning inventory, but we do not consider the beginning inventory first purchased. When we consider the cost of goods sold now under the LIFO Perpetual system, we take into account the last in first. So from there, that's correct. So 200 out of 300 purchased on April 28 times 14. So we have 2,800 cost of goods sold. Okay, so it's not a necessary information, but in order to just show the unit cost, then we got this here. So do you see the $14 the same as this? Because we assume that cost of goods sold, the inventory came from the inventory purchased, the last purchased. So let's calculate the total cost of goods sold here and here. And then let's sum up this cost of goods sold. We calculate it. So 8,000. And then the ending inventory, again, ending inventory, the same precision, 950 total available sales unit minus the cost of goods sold. And here also, the same as this way, 11,400 minus 8,000 in the same way. But for the purpose of this studying ending inventory, now how do you get the ending inventory as well? 300 here, 200 here, and then 450, so 200. So here, let me calculate 100 out of 300, right? Times, we are calculating just the leftover amount, 14, plus, do you remember here we have had the leftover from the purchase on the beginning inventory. How many? That's correct. We use 400 up and we have 200. Here we go. So times $10. We have the same result. Anyway, same result. So the sum up of this and the sum up of this should be the same as all the inventory purchased or in dollar amount, unit and dollar amount. So let's compare these two results. Now, do you see the periodic LIFO and perpetual LIFO has different amount of the cost of goods sold and ending inventory? Because again, the cost of goods sold under the periodic LIFO is higher than the cost of goods sold under the perpetual LIFO. Because when you consider the cost of goods sold at the end of the period, we started from 14. We started from 14, right? We started 14. So that's why we assume that the expensive one sold out, because out of 650, we used up this 300 inventory cost, which is the expensive one. So leftover is the cheapest one, definitely the cheapest one, right? But in this case, okay, we also had the cheapest, the beginning inventory, but only how many? Okay, here when you calculate this, now we use only 50, only 50 here, right? Only 50. Then when you calculate this, we only calculate 200 out of 300. That's why the total cost of goods sold under the perpetual is now lower than the cost of goods sold under the period LIFO. So the perpetual LIFO, we follow up every moment we sell our product and consider the cost of goods sold at the moment from the last in, first out. And the last in, first out. Okay? Okay, then see you the next video clip.